We are back and we are moving on to Chapter 5. I hope you've already read the chapter because it really walks you through the transactions. We're just going to talk about some overview type stuff. So we're back to talking about, like on page 35, the governmental funds. And we've already talked about general and special revenue. General being, just the catch-all, whatever, running the government. And the special revenue is when funds are set aside for a certain special thing. Like for City of Kingsville, they had the police forfeiture fund, and it has to be used for public safety. So you have a special fund, special revenues, and they have court renovation and debt service. So now we're going to talk about these three other types of funds. This example city doesn't have a permanent fund. We're going to talk about capital projects, which courthouse renovation would be a capital project, and we're going to talk about debt service, and then we're going to talk about permanent funds, which are slightly different from special revenues and slightly different from fiduciary funds, but it's kind of same general deal. They're only used for like one thing. All right. So you might, like I said, you might want to have 35 open so you can kind of make sense of the different kind of funds. All right, so today we're going to talk again still about modified accruals because these are governmental fund accounts, right? So we've got your three main categories of funds. You've got governmental funds, you've got proprietary funds, and fiduciary funds, and within those categories, there's subcategories, right? And the governmental funds, right? Those governmental funds, the general, the special revenues, and the ones we're going to talk about today, capital projects, debt service, and permanent funds, today's, they use modified accrual. Nothing else does. Everything else is just straight up old accruals, but we'll worry about that later. So we're going to learn how to, do these fun things and look at the statements and understand how they work. All right. So reminding ourselves, modified accrual basis is not accrual basis accounting because that weirdness with the revenues, right? We have tax revenues and grant revenues. So we don't say, oh, we've provided the service or sold the product, because sometimes there's not an exchange. So when do we recognize our revenue? Well, when it's measurable and available. That's revenue recognition. And we have expenditures, not expenses, and they just go in the period they happen, regardless of how they match with revenues, which is how you do expenses in accrual-based accounting. You match them. These don't really match. They just, when you do the expenditure, it's an expenditure. Basically when the liability happens. So if you receive something and now there's an account payable, that's when that happens. All right. Again, we did already learn that when the budget is appropriated and the taxes are levied, we set up that budget. Right, so there are budgetary accounts, there's encumbrance accounts, right? So budgetary accounts is when we say, hey, this is how much money you have to spend this year. Here's your budget. And you actually book it as a budget. Then, when the government we're doing the accounting for decides to commit some funds, right, we're going to buy some computers, somebody's going to take a trip. We're going to pay for school lunches. So whatever they commit to, we encumber those funds. So we have the separate encumbrance account, right, that we move to. And then when the actual expenditure is recognized, then we have our actual expenditure. So we kind of have the activities accounts. Those expenditures and revenues, those are activities accounts. So remember, typically, you're not going to need encumbrances for the debt services, but a capital project, right? So capital project like building a new fire station or a new courthouse or something, buying a fire truck maybe. Those capital projects, those could have encumbrances. All right. Now, generally, the assets that are a result of the projects, so you can imagine you have a project to build a new police station. So that's going to be a building, right, at some point. That doesn't go in these funds, right? These funds are showing the activities, the revenues, the expenses, the expenditures, right? Not the actual ultimate asset. That's going to go on the government-wide document. So anyway, long-term debt proceeds are just other financing. So you're not seeing the liability, the long-term liability. All right. So a capital project fund is a separate fund for financial resources restricted, committed, or assigned for capital outlay. So a capital outlay is something like building a fire station, building a new city hall annex, building a jail. So capital outlay, a big project. Now, some capital projects are under proprietary activities, right? So we know that eventually we've seen proprietary funds. It's one of our main categories. We haven't really talked a lot about them like we have governmentals. But remember, a proprietary fund capital project would go with that proprietary fund. So let's say the water department is a proprietary fund, right? They sell water, they service water for people. So they actually earn money. It's like a separate business, so it's a proprietary fund. Well, if the water department decided to build a new water treatment plant, that goes with the proprietary fund stuff. Okay, so capital projects are things that are general government stuff. They're not something you find as a proprietary fund. So typical proprietary funds are things like the water department, the electricity, things that actually earn service fees. They're running like a business. All right. So keep that in mind. A lot of times you issue bonds that give the money for these capital projects, right? So if you're going to build the Harbor Bridge over in Corpus, that's going to cost, I don't know, probably billions of dollars, at least lots of millions. And they're going to issue bonds for things like that, right? So a lot of times these bonds are the other financing sources. So you use these capital project funds to keep track of the construction, right? So once that thing is done with, the fund is done with. So the primary sources for capital project are bonds, which you should know what that is, right? It's a debt instrument that can be sold and traded on the market. A bond gets issued by governments can issue bonds. Grants from other governmental units. So the state gives the city of Kingsville money to fix some streets. Dedicated taxes. So for a capital project, sometimes they have dedicated taxes. They say we are going to use the taxes from. We're just going to charge tax to build something. Right? So that, like, we're going to build the Alamo Dome and we're going to charge a tax to build it. Transfers from other funds and some donations, and of course the funds themselves can earn interest. So how do you book a bond issue? It's pretty simple. It's not a revenue, it is a liability, but we're going to call it other financing sources, bond proceeds. So when the city or the state or the county or whoever it is issues the bond, obviously they sell the bonds and the cash comes in, right? And that becomes something they owe. So the transaction for that is cash debit because cash increased, and then other financing sources, bonds proceeds, $12 million. So that's the fund transaction within the capital project fund. Okay, now, depending on how many capital funds you have going on, you may actually use separate funds. If you notice on page 35 here, they have courthouse reconstruction. And so you might see another column, something like new fire station construction, something like that. But sometimes they just keep one construction fund and then they have project 1, project 2. Either way is okay according to GASB. So the point is you want to make sure you're able to track the funds and the expenditures to the proper project. Okay, so that's a debt service, a capital project fund. So let's come back and talk about debt service funds.